part of a smart base financial plan so you can retire smarter, live confidently, and leave a lasting legacy. So I'm your host. Meet your host. I'm Myra McCaskill Crenshaw, certified public accountant, real estate wealth advisor, and tax strategist. I have been in the business doing this for a long time, well over 20 years. I know so I started when I was 10, but I help families connect the dots between their faith and their finances and their stewardship so every decision supports your purpose, your peace, and your prosperity. I serve clients from all over the world in all stages of life. From your first time home buyer, where you're building that foundation to get to where we're talking about today, to growing families that want to upsize uh, as in their next size of a home, to the retirees and right sizers who are ready and preparing for their next chapter, and also to investors who want to build wealth through building a cash flow and also using tax loopholes for that. So whether you're buying, selling, or building, I bring both financial strategy and real estate expertise to help you make you a smart, tax efficient moves that align with your life and legacy. And tonight we're focusing on a program that helps families all across the country unlock the equity that they've built in their homes and use it to create financial freedom, flexibility, and a peace of mind. And I'm so excited to have my special guest here, Genie McGee, that will share. But first, let's talk about from building wealth to leaving a legacy. As we know, the first step to building wealth is to get assets. And one of the ways that you can get an asset is through buying real estate. A lot of us may own a home and some of us may not, but we're talking about the building blocks on how Jeannie is going to come in later on to explain to us how we can build that, take that non-liquid wealth in our home and make it a really great financial and retirement planning tool. In fact, wealth is built in various ways. But over 90% of millionaires and multimillionaires own some form of real estate, and they leverage that. Why? Because real estate creates equity, appreciation, and tax advantages that grow over time. But the next step, especially after 20, 30, 40 years, is learning how to use that equity to fill our next chapter. Some of us may be in our first time homes where we bought it 10, 20, 30, 40 years ago. Um, and we have this huge amount of equity that we're sitting on. So tonight, we're just exploring the tools and the toolboxes of what you can use for your financial strategy. One of the things that after you've been in a home and you're ready to transition, you normally hear it as downsizing, call it right sizing, because you're finding the right house in your next season. So like for some of my clients, they may have a 2-story home that's 3,000 square feet, but they just want to go to a ranch that's a 1-story home. So that's the same size. It's still 3,000 square feet, but that home, that single story aligns with where they're at in their season in their life. So when you do this strategically, your home becomes more than just a roof over your head. It becomes a powerful tool for retirement, estate planning, and leaving a legacy. So let's go over what we're going to talk about today. So we already went over our purpose. I'm gonna quickly talk about tools in the financial toolbox. And that one tool that you'll learn new today is called the HECM. And Jeannie will go into that into detail. And she'll go into what the acronym means too. um, we'll talk about using wealth and retirement and estate planning. We'll have questions and answers, and then we'll talk about next steps. So, tools in your financial toolbox. As a CPA and real estate wealth advisor, I always say the right plan requires the right tools. Here are a few tools you'll want to have in your financial toolbox. One is tax and wealth strategies. So your money works as hard as you do. And I talk about those. We're not going to talk about that tonight, but we're adding one additional tool tonight. The home equity conversion mortgage, which is unlocking home equity for retirement. And that's what we're talking about tonight. Another tool is life insurance and legacy planning. I'm trusting that we all have life insurance. I'm not a life insurance agent. I do have partners that do that. But that is another tool to build generational wealth. And then estate and charitable planning, ensuring that your values that your value and your legacy lives on. And we're not going to talk about that tonight, but those are just some of the tools. So your home is one of your most valuable and often most overlooked financial tool. So tonight we're going to show you how to leverage what you already have to fund your freedom and protect your future. So why this matters? Why is unlocking your locked equity in your home matter? Well, let's talk about it. We're living longer, right? We are living longer, and that's a blessing, but it means we must plan smarter. This conversation is about preserving your cash flow, protecting your savings, and strengthening your legacy. So here's a stat. Less than 1 in 200 heirs actually keep the home that they inherit. Most of them sell it. And I have come to realization of that. You know, my dream was to leave my home for my children so they can bask in glory in the home house. But after I've had personal experiences in my family when my grandma passed and trying to leave the home house, most of them, you know, some of them wanted to sell, some of them wanted to keep. And like Jeannie just brought it up to me, it's like you can't divide a house, but you can divide cash. So, and then just in my real estate journey as a wealth advisor, I will say that percentage is right where, you know, when my clients inherit a property, and I do work a lot in probate, I liquidate so many assets. I really, really want them to keep it, right? Because, you know, they're not building any more land and they're not building any more land. But most of them want to sell. So, you know, my number one strategy is to keep that home. But because you can't divide a home, they end up selling. So just maintaining that dream of buying a home and passing on equity, this is a different strategy that we're looking at on how you can use that equity in your home. A smart plan doesn't just leave property, it leaves options, liquidity, and peace. And so we're going to talk about that now. So now I want to introduce the special guest at hand. We're going to walk through the HECM program, especially for those looking to purchase their next home or even just planning, right? We always want to plan. And I'm honored to introduce our special guest, Genie McGee, Senior Vice President of Reverse Lending at Fairway Home Mortgage. Jeannie is a nationally recognized retired mortgage specialist. She's helped countless of families across the country unlock freedom, confidence, and a peace of mind in retirement. So it's a pleasure to introduce Genie as she brings forth this very, very important tax planning, well, estate planning, retirement planning, tax planning tool for all of us to know. And I will say that I literally just found out about this program about 3 or 4 years ago. Actually, when you were just during the pandemic, when you were just soaking up all the information that you had to do for living at home. So this has been a phenomenal opportunity, and I'm just passionate about sharing this and putting this tool in your toolbox. So please welcome with jazz hand. We do jazz hands and Toastmasters. Our reaction, Miss Genie McGee.
Thank you, Myra. I appreciate it. Hello, everyone. Good evening. Let me get my PowerPoint pulled up and we'll dive right in to what I have to share with you tonight. Um, I will take about, um, I'll take about 20, 25 minutes talking about this product, and then we will open it up for question and answers. If you have questions for me, or if you have scenarios you'd like me to go over, or something I said that sparked something, feel free to write that down as I'm going through, and then we'll address that as soon as as soon as I get through presenting. So we're going to talk about the home equity conversion mortgage for purchase loan. And I'm going to share a story first about Cindy. Cindy is 70. She's selling her current home, which she owns free and clear. Cindy wants to do what a lot of my clients want to do. She wants to move closer to the grandkids, not the kids. The grandkids is who they really want to be close to. And because the kids are kids, they're with their parents, right? And so she's selling her house that she owns free and clear. She's moving closer to them. And she wants to take some of the proceeds from the sale of her house and set up an annuity for those grandkids, right? And so she's trying to figure out how to do all of that. Cindy's 70. She's on her own. She's trying to figure out. So she finds out about this home equity conversion mortgage for purchase, or you might know it as a reverse mortgage. Reverse mortgage is what we call it. Its formal name is home equity conversion mortgage. It is an FHA product that's been around for 37 years. It was actually signed into law back in 1988 by President Reagan. So it's been around for a long time. Her realtor told her about buying a house using a reverse mortgage, which will allow her to not have to use all of the equity that she nets from the sale and will give her money so that she can set up that annuity. So in this case, Cindy's home is worth $400,000, and the house that she's buying is worth $375,000. So she obviously has enough to buy the house in cash, but it would only leave her $25,000 left for that annuity that she really wants to do. She has two goals. She wants to move closer to the grandkids, and she wants to have this annuity in place. So Cindy at 70 can bring a one-time down payment toward that $375,000 house, approximately $254,000 she can bring. And the reverse mortgage lends her the rest of the money to buy that $375,000. And what that does for Cindy is that means Cindy has $121,000 left over for that annuity, and she's in a home that's close to her grandkids, and she doesn't have a required monthly mortgage payment because her financing was a reverse mortgage, which doesn't require payments until a borrower dies, moves, or sells. So when you don't have a mortgage payment, which is typically the largest line item in your budget, it means that not only do you have more money, but you have more cash flow. And that's what we talk about when we're talking about older adults, either in retirement or pre-retirement. It's all about cash flow. I know realtors talk about location, location, location. We talk about cash flow, cash flow, cash flow, because that's what's really important when you're in retirement. We have another couple, James and Mary. They're a bit younger, they're 64, and they want to buy a home in a 55 plus active adult community. It's a new construction home. They put off, like a lot of us do, we put off what we really want to do because we're raising kids, we're building our careers, we're living our lives. But when we get close to retirement, we're thinking, okay, what do I want? And they want to buy this house in this 55 plus active adult community. It's a lot more expensive than what they thought. They hadn't bought a home in many years. It's $600,000, right? And so their realtor is the one that told them about the home equity conversion mortgage for purchase, or we like to call it a HECM for purchase. HECM is just the acronym for home equity conversion mortgage, HECM for purchase, or H for P. So James and Mary sold their home for $373,000 and are going to buy the $600,000 home. Now, when we determine how much we can lend, we use three criterion to determine that. We look at the value of the home, in this case, $600,000. We look at the age of the borrower, 64. And the age is important because the older you are, the more money you actually qualify for. And then lastly, we look at the interest rate. So when we did their math, they have to bring $428,000 to the table, right, as a one-time down payment. Now, they won't necessarily have all that from the sale of their house, but they have assets. So they're going to bring all the money from the net proceeds when they sell their house, plus they're going to dig into their retirement assets and bring the other amount, right? About $50,000, $55,000 to the table is what they have to bring from this other asset. So the combination of the net proceeds from the house they're selling and the money they're bringing from their assets, they're able to bring a one-time down payment to the table, and the HECM for purchase will bring the rest. That's the financing. And so they're able to be in this dream house, new construction in a 55 plus active adult community with no mortgage payment, right? Which sets up not only better cash flow, but there's some opportunity cost. If you don't have a mortgage payment, what could you be doing with the money that you typically would be paying in a mortgage payment? Like you can invest that. You can buy insurance, like you can do some things. There's some opportunity costs that you give up when you have a mortgage payment. And most of my borrowers, all of whom are 55 and older, don't want to move and have a mortgage payment in retirement. Like they want to move, they just don't want to have a mortgage payment in retirement, right? And so if James and Mary had taken out a traditional mortgage, they're 64. Most traditional mortgages are 30 years. So that literally means they would be making a mortgage payment until they're 94, which is not attractive. Plus, I always tell my clients, if you're a couple, couples don't die at the same time, right? You rarely hear about that. And statistically, the husband predeceases the wife. And we deal with a lot of widows who are struggling for the first time in their life when their spouse dies, right? Because you don't get both Social Securities. If he had pensions, sometimes the pension doesn't survive him. So it's really super important for most retirees to not have a mortgage payment in retirement. So how does this H for P, HECM for purchase loan, how does it work? What is it? It's an FHA insured loan. It's been around for 37 years. It was actually signed into law back in 1988 by President Reagan. Initially, it was only for refinances. In 2008, HUD introduced the ability to use it as a purchase product. So we use it both for refinances for folks who want to stay in their home, and we use it for purchases for people who want to sell. In this particular program, you have to be 62 or older. Now, if it's a husband and wife, only one of them has to be 62. The other one could be younger than that. And that's true in every state except for Texas. So if you live in Texas, it's special. Both of you have to be 62. Now, it's an alternative to what most of my clients think there's only two ways to buy a house. They think either you take out a 30-year mortgage, which is not really attractive to them, honestly, or you pay in cash. Many of them haven't bought a house for 20, 30, sometimes 40 years, and they get payment shock when they're starting to look and they find this perfect house and they realize how expensive it is. Think about it. If you have $300,000 in net proceeds, but the house you really want is 550, that's a hard pill to swallow. So there's lots of older adults who are in that position. They found the house they want, they just can't afford it, or they're not willing to either take on a mortgage payment for 30 years or drain their savings to pay for it. And it's important because 12,000 people turn 62 every day. That's those baby boomers. Anybody born between 1946 and 1964, baby boomers, a whole glut of people were born during that time, and they are retiring. So there's a lot of people trying to figure out their housing and their financing. So with this H4P loan, HECM for purchase, you bring a one-time down payment to the table. That amount always is a little bit different because I told you we look at three things: the value of the house, the interest rate, and the age. So if you're 74, you bring less money. If you're 84, you bring even less money. But if you're younger, you have to bring more money. Why? Because we lend out more money the older you are based on actuarial tables. Okay. The beauty of it is it that you can get into a house, the house that you really want. You don't have to settle, and you don't have a required monthly mortgage payment. You're not giving up the title to the property. You still own the house, but you don't have a required monthly mortgage payment, which is typically the largest line item in your budget. You are responsible for the property taxes, the homeowner's insurance, the HOA, the utilities, the maintenance. What it really does, it increases your purchasing power. So you do not have to settle if you know the house that you really want to be in. So we talked about this. We alluded to this. There's three ways to pay for a home. Everybody knows this way, where you pay a one-time down payment of 20% or so, and then you make a mortgage payment for the next 30 years. Like, we're all familiar with it. It makes sense if you're 30. It may even make sense if you're 40. It probably doesn't make sense if you're 70, right? To take out a 30-year mortgage. People do it all the time. If you were buying a $600,000 home, if James and Mary decided to do a traditional mortgage, their payment would be $3,264 per month for the next 30 years until they're 94, and they will have paid over $1 million by the time they had paid that house off. Okay, so that's one way, and my clients know about that. The other way that they know about is to pay cash. Like, they feel like, if I sell my house and pay the realtor cost, pay off any mortgages, I want to use whatever's left to buy a house in cash. Why do they want that? Because they don't want to go into retirement with a mortgage payment, right? They get it. They understand that's not good. They understand the risk they take. And so they want to buy in cash. The problem is housing is expensive, right? It's a lot more expensive than what they remember when they bought their house 30 years ago. So even though they may want to buy in cash, sometimes they're not able to buy in cash. And even borrowers who have the cash, because we have borrowers who come down here from New Jersey and New York and Chicago. Real estate's much more expensive up there. And so they actually have the cash. They could buy in cash. They could do it. But when they learn about this HECM, it allows them options, flexibility, what Myra was talking about, having options, having flexibility, and being able to keep more of their money in their pocket. Because, to Myra's point, equity is wonderful, right? We love equity in our home, but equity is not spendable, right? It's not like you can take a picture of your house and go on a cruise. It doesn't work like that. So the equity, we say it's lazy. Why is it lazy? Because it's not working for you. It's in your house. You can't spend it. You can't do anything with it. So that's the other option. We let our borrowers and their real estate partners know there is a third way to buy a house, and it's this HECM for purchase. Most of my clients are taking the one-time down payment from the net proceeds of the departure home they're selling. So often we have clients who are in a house that was great when they bought it in the 30s and 40s. They were raising kids. They needed lots of bedrooms and bathrooms. It's usually two-story, which means it has steps. But now that they're 70 or 80, it's not so great. It's too big. They're having a hard time navigating the steps. It's not in the right place. It's not close to the grandkids, all the things, right? And so there's a lot of people who would love to be able to get into a ranch or a 55 plus or a condo, but they haven't been told how. And so this HECM for purchase is a great way to do it because they usually just take the money from the sale of their house as the down payment. They do not have to use all of it. It all depends on what they're buying. And then we bring the finance portion to the table, the reverse mortgage, the HECM, right? The home equity conversion mortgage brings it. So the combination of what they bring from their net proceeds and what we lend allows them to buy the house in cash, and they don't have a required mortgage payment. The payment is not due until they die, move, sell, or turn 150. And the reason we say that, I don't know anybody who's 150. My oldest client is 103. I don't know anybody who's 150, but most states require that you put a due date. We don't know when the due date is. It's not a 30-year mortgage. It's not a 40-year mortgage. We don't know. And so what we do, we make the youngest borrower 150, and that's the date we put on the note when we record it. Okay. So that's how it works. So the benefits of buying with this HECM for purchase is one, you can purchase the home you want, like in a 55 plus community. To Myra's point, it's not about downsizing, it's about right sizing. Sometimes we have buyers buying more expensive homes. Sometimes we have buyers buying homes that are bigger, right? It's not always downsizing. We say right sizing because we want to get our clients into the home that they want to be in, right? They want autonomy. They want to live where they want to live. They want to live the kind of way they want to live. So it increases their purchasing power. It allows them to have flexibility in what they buy. They don't have any required mortgage payments. Now you can make payments, and I do have clients who make payments into this, but they're not required payments. They're voluntary payments. And so when you make these voluntary payments, you make them in whatever amount you want and as often or infrequent as you want. Because you own the property, you have title to the property, you are responsible for the property taxes, the homeowner's insurance, the HOA fees, and utilities and maintenance, all the things that come along with home ownership. You just don't have the most expensive thing, which is the principal and interest payment if you don't want to pay it. You can move closer to family. You can move in a better neighborhood or in nicer weather places. You can purchase a home, again, based on your age and the interest rate for as little as 45 to 70% down. And we can close really quickly. So we can close in 17 days if that's what you need and if that will help you win your offer. We tell our clients, make memories, not mortgage payments. In retirement, it's all about memories. It's about legacy. It's about family. It's about living your life on your terms. Why make mortgage payments when you could be making memories with family, friends, and others? So it stopped sharing, so I'm going to start it again. I don't know what happened. It happens. Hold on. Sorry about that, y'all. Hold on. Technology, we love it until it doesn't work, right? And then it's like, gets on our nerves. So it's all good though. So where were we? Okay. I'm trying to get it so I can. So I am not able, Myra, I'm so sorry. I'm not able to. Okay, now I see it. Never mind. Okay, let's go back to the making memories. Okay, make memories, not mortgage payments. We talked about that. So there's opportunities. I talked about opportunity costs when you have a mortgage. So if you didn't have a mortgage, what could you do with that money? Lots of things. It's really personal, but one of them is you could invest. Like you can buy insurance, life insurance. You can buy long-term care insurance, which is a big issue because only 2% of Americans have long-term care insurance. And the experts, the researchers are saying that 70% of us will need long-term care at some point. And it's super important. I don't know if you've ever had to care for somebody, but I have a client who is paying out of pocket $15,000 a month for her care. It's super expensive. And so you can invest and have that money grow for you. You might have a hobby, right? You might have a hobby that you want to spend money on, but if you're making a mortgage payment, you don't have the money to spend on that hobby. So that's another thing. Or like me, you might want to travel. I love to travel the world. So it takes money though to do that. So if you didn't have a mortgage payment, you could really, if you had a $2,000 mortgage payment previously, and then you buy a house and you don't have one, that's $24,000 a year. Like you can take some really nice trips. You might be able to take 2 or 3 trips with that kind of money. So people use it for travel. And then, of course, those grandkids that you love to spoil. So not only spoiling them, but sometimes we have our borrowers who are paying for their grandkids to go to private school or paying for their tuition in college. Like there's lots of opportunities. We always tell our clients, you're going to spend your money, the money in your house, what we call housing wealth, you're going to spend that. Do you want to spend it with a warm hand or a cold hand, right? You're going to spend it, right? Do you want to be around when you spend it, or do you want to be dead when you spend it? Because if you die with all this equity, guess what? Your heirs get it and they get to have fun, right? They get to spend your money, right? And you're spending it with a cold hand. So we always talk about problems and then having solutions for that. And that's really what real estate agents do, and CPAs do, and financial planners do, and loan officers do. We're trying to find out what the problem is, what's your issue, and then trying to find solutions. And the reason housing wealth often is the solution, because most Americans' largest asset is their home, right? It's bigger than their IRA, their 401k, or all their assets. So one of the problems that we see folks saying, we can't sell our home in this market. The market's bad, right? You hear that. I can't sell the home. We're having a problem selling the home. And or we need to take more out of our investments to purchase the new home for cash. So they drain or really severely handicap their retirement savings just to buy a house in cash, right? And so the solution with the HECM for purchase is you'll be able to sell your home for the true market value, not what you want, but what it's actually worth, resulting in a quicker sale and be able to get everything you want in a new home because you're not buying it in cash. You're not having to qualify for it with a traditional mortgage. You don't have to qualify to make this mortgage payment for the next 30 years. That's a solution, right? Not for everybody, but for a lot of people, it is a solution. Another problem, you have to sell your existing home prior to purchasing your next home, your dream home. And that's not necessarily the case with the HECM for purchase. So you do have to bring a one-time down payment to the table, and it's fairly large. But if you have those assets in another bucket, not just the housing bucket, and you want to keep your current home, you could. You don't have to sell that current home. You could keep that home, bring your one-time down payment from your assets. We bring the rest to the table, and now you have two homes. One of them you could rent out, right? It could be an investment home, which it's bringing in money. So there's some really creative ways to engage this HECM for purchase and still get what you want, maybe get more than you want. Another problem is you can't get what you want in a dream home because you have limited income and you don't want to put all the cash on the line, right? Maybe you do want that $600,000 house. That's your dream home. But you can't figure a way how to get that $600,000 home. There may be a way if you're 62 and older. And I will tell you, we're talking mainly about this HECM for purchase, which is an FHA product. It makes up 97% of the reverse mortgages in the industry. But that other 3%, there are four proprietary products that allow you to do a reverse mortgage when you're 55. So you don't have to wait until you're 62. You can be 55 and buy a home using one of those proprietary products. So in this case, the solution with the HECM for purchase, you can retain a big portion of your cash and still live in the house of your dreams. So you don't have to use all the money from the sale of the house. You remember the woman, the first example we gave, and she wanted to buy an annuity to help her grandkids. She was able to buy the house she wanted using the HECM and have $121,000 left. So there's lots of creativity and flexibility that you open up when you have another product to use. What you need to know about the HECM for purchase loan. Big thing, we don't use FICO scores, y'all, which I love. There's no minimal credit requirements. We do pull a credit report, but we don't care what your FICO score is. We're only looking to see, have you been able to pay your obligations on time for the last 2 years? Okay. There's no minimal income requirements. Why? We're not underwriting for your ability to pay a mortgage payment. We're underwriting for your ability to pay your taxes and insurance, which is a much lower threshold. And the biggest one, there's no required monthly mortgage payments. Again, you can make payments, you don't have to. And that adds flexibility. So what are the qualifications? You have to be 62 or older if you're doing the FHA HECM program. If you're husband and wife, only one of you has to be 62. So you could be 62 and have a spouse as young as 18. Like, I've never seen it that young, but you could conceivably. The HECM for purchase loan must be on your primary residence. So you can't do it for an investment property. It has to be on your primary residence. Though I will say, I have had clients who own their home free and clear. They do a HECM refinance, not a purchase. They want to stay in their home. They do a refinance to unlock some of the equity in their home, and then they use that money to buy another home, an investment property. So you can do that all day long. Anything you do with the money is totally up to you, and it is tax-free. Why? Because it's not considered income. It's a loan, right? So you don't pay taxes on it. Money brought to the closing must come from the sale of an asset account, or gift funds. They cannot be borrowed funds. So you're not able to borrow funds. Even you can't borrow funds from your 401k or your life insurance policy. You can't use borrowed funds in this particular product. It has to be from one of those three sources, from an asset account, from the sale of an asset like a home, or as gift funds. And then what are you responsible for? So when you go into a HECM, you have some responsibility. You own the house, but there's a mortgage on it. The mortgage is recorded in the county deed records. You just don't have a mortgage payment. So you have a mortgage, you just don't have a mortgage payment. And you are responsible for paying the property taxes. You are responsible for paying the homeowner's insurance. And if you're in a homeowners association, you're responsible for paying the homeowners association fees. And you're responsible for the general upkeep and maintenance of the home, like you would with any home that you own. So I say enjoy a more comfortable retirement with a H for P. You'll own your new home and you don't have to pay it back until you die, move, or sell. When that happens, your heirs will inherit the home. They will have up to 1 year to pay off the balance. Typically, they sell the home. Myra stated a stat that only 1 in 200 heirs ever keep a home. Most sell it. Why? Because you can't divide a house amongst 3, 4, 5 heirs. I have 3 sons. How will you divide a house amongst 3 of them? But you can divide money, right? You can divide money. So I always ask, it's all about lifestyle, and it's about this one life we get. We get one life, right? It's not a dress rehearsal. This is it. Wouldn't you rather be making memories versus mortgage payments? So the next steps are you can download this guide, the 62 plus home buyer guide, by just scanning this QR code, or you can reach out to me and I can send it to you. Okay, so you can scan this and I'll come back to it in a minute, but you can scan this and be able to, or take a picture of it and scan it later to get this digital guide on buying a home with a HECM. You can schedule a call because everybody's situation is a little bit different. So I ask lots of questions, trying to figure out what you're trying to accomplish, what the goals are, and how I can possibly be helpful in this situation. And then we go over the numbers with you. Like we either face to face, on the phone, or on a virtual call, we go over the numbers, answer questions. You do have to get counseling with this program. So you're talking to a third-party counselor to make sure you understand it and that you're of sound mind, right? But the education piece is super important. Getting the questions answered. There's a lot of misconceptions, a lot of street committee knowledge out there that's just simply not true. And in order for you to make good decisions, you have to have good and accurate information. So I work for Fairway Mortgage. We've been around for 29 years. One of the reasons I've been here for 9 years is that they have a really strong HECM division that closes HECM loans at a high level, very quick, and we love the work we're doing. We're passionate about it. My name is Genie McGee. I'm a retirement mortgage specialist. That's my contact information. You can feel free to reach out to me at any point if you have a question, if you have a scenario, or if you just want to learn more. I am always available. And so what I'd like to do now is see if anybody has any specific questions for me that I can entertain. Anybody? Any questions that are burning and that you're not sure about, but you'd like to know? Anything that I said that wasn't, and you can do that. You can write it in the chat. You can raise your hand, or you can unmute.
All right. Well, Jeannie, thank you so much. I will go ahead and start off with the questions.
Okay.
All right. That was so powerful. Um, Thank you so much. I know a lot of people are hearing or may have heard about this program for the very first time tonight. And so you may be wondering how this could apply to your situation. And so we're opening up the question. Some question is, You mentioned that no mortgage payment is required.
Mm-hmm.
But what happens, and if you can explain it in detail, what happens when one chooses to make a payment and how does that work? And I know I'm asking this for to educate the general public. And how does that work with the line of credit? So can you explain that to
Yes, so
the
we have
audience?
three distribution methods for the money that you can get. You can get a monthly payment if you're doing a refinance. You can get a lump sum, but we also have this line of credit. And I tell people the HECM is not sexy, but this line of credit is sexy, right? It's sexy. And it's sexy because if you made a payment, let's say you bought a house and you use all the proceeds from the loan to buy the house, right? And you decide to make payments because you're still working, right? And you're like, let's make payments. Three things happens when you make a payment. It does pay down the mortgage balance. Why? Because you're treating it like a traditional mortgage, right? You're making payments. Two, you will get a 1098 because you've made mortgage payments, right? You can write
That's
that
good
off.
for
Yeah,
taxes, right?
taxes, yes, if it makes sense to write it off. But the big thing that happens is that money, dollar for dollar, goes into the line of credit, and the line of credit has a growth feature. So the money grows, right? Currently, that growth feature is 6.5, right? It's always tied to the interest rate. So when our rates were super low during the pandemic, they were like 3%. The growth on the line of credit was 3.5. But now that the rates are like 7, I mean 6, the growth is 6.5. So that money, let's say you decided, baby, we're gonna pay a mortgage payment $2,000 every month. At the end of a year, you will have $24,000 that you've paid into this line of credit, and it's grown currently at 6.5%. Like that's
Good.
exponential. And you can take that money
Yes.
out and use it any way you want, anytime you want. There's no questions asked. It's your equity. But that growth feature is sexy to me. So that's why people make payments for reasons. That's one of the reasons. Another reason is for tax reasons. Like
Yes.
there's some tax strategies that people use that for. And then the other reason is for long-term care or other things in the future that could come up. It's better to have money before you need it because when you need it, sometimes it's difficult to get to.
And if you think about just the long-term national 30-year average of home appreciation, so the average is anywhere from 2 to 3%, going through all the recessions
Well,
and where we've seen. So having that feature above national average of home appreciation is really a great feature and a great opportunity
yeah.
for
And it
that.
grows even if the house doesn't, right? So even like during the downturn in the economy and the housing crisis, I had a client who had taken out a line of credit, and her line of credit actually was more than the house was worth. It's crazy, right? So,
It's really crazy. So another question that we get, or that we normally get, is, so what exactly happens when you leave, when the borrower that took out the HECM permanently leaves the home, i.e. they pass away? How does that work? When is the loan due, and how does that impact the heirs?
so it's funny. A lot of times my clients will say, "Well, what happens if I die?" And I always laugh, right? It's like something's going to happen. I don't know what, I don't know when, but something's going to happen, okay, in the future, right?
Happen.
I don't know, right? So,
Yes.
so when the last borrower no longer occupies the home, that's really what we say because it's die if you permanently move out, which is being out for 6 months, consecutive months, or if you sell the home, of course. The heirs have up to 1 year to pay it back. Typically, they
Okay.
sell it, right? They don't have to sell it though. They could refinance it, right? They could refinance it if they want to keep the house and pay a traditional mortgage. We've even had people who inherited it, wanted to stay in it, and qualify for their own reverse mortgage, right? So you could do that. But think about it. We've had money outstanding 5, 10, 15, 20, 30, 40 years, depending on when that person dies. So the money's due, right? The money and the interest that is accrued against it is due, but they can do anything they want. They can turn it over as a deed in lieu of foreclosure. They can sell it. They can refinance it. The big thing to keep in mind that you can never be upside down with this product. Why?
Right.
Because
That's key.
that's
That's key.
key. It's called being non-recourse. It's the legal term that means no personal responsibility. So even if you die in a year like 2008, when the value went down and you were upside down, you're not really upside down. Why? Because the lender just makes a claim against that insurance policy. Your heirs are never having to come out of their pocket to make up the difference. And that's important.
That's very important that it's non-recourse, meaning that the heirs are not responsible for it. Another question, let's go back to that example of where he was 62 and she was 18.
I told you, I've never done that, but the biggest gap I've seen, I had a borrower who was 68 and his wife was 34. There you go.
So let's talk about that. What would happen in that scenario? So do you do the calculation based upon the youngest spouse? And can you just talk a little bit more about that, how that is done? And because some people may be thinking they need to go find a 62.
Hey, hey,
And
hey.
then and then if he passes or she passes, because it could be the reverse. She could be 62 and he could be 21.
That's right. That's right.
What happens to that younger spouse if the older the one that qualifies passes away?
So HUD was actually sued over this issue, Myra, and that's why it's important because one of the things that happens with litigation is that if you win, it changes the rules, and it did. It changed the rules, and so what the rule is, if you're 62 and you do a HECM and your spouse is under 62, that spouse is not considered a borrower. Why? Because they're not 62 yet. This program is for 62-year-olds. But that lawsuit made them an eligible non-borrower. And what are they eligible for? If that borrower predeceases them, as long as they get the house, like either they're on the title or they inherit the home, they get to stay in the house until they die, move, or sell,
Oh, wow.
right? So it's important because it protects a spouse who's underage. Because it used to be, when I first got into the industry, if you were 62 and your spouse was 55 and you both were on the title and you wanted to do a reverse, that younger spouse had to come off title. That is not a good idea to come off title, right? Because if that spouse predeceases you, and often it was the man that was older,
Right.
often he was the one that predeceased them, she might own the house, but she got to pay that mortgage back because she doesn't have any rights. But this lawsuit that HUD endured and lost made it so that that spouse, as long as you're married and you live together in the same house at the time of the HECM, you have protection. And so even if that borrower predeceases you, you can stay in the house. So if you're 18, you're not going to get a whole lot of money, but you will have a house for the rest of your life that you never have to make a mortgage payment on.
And you just got to pay those taxes and the home insurance.
Correct.
Okay, that may be a good little strategy. That is really, really great insight and information to know. Is there any, all right, well, those are my questions. Our time is almost up. Does anybody else have any questions?
No? Well, I will say, as we talk about the end of life, that I encourage every client to get their estate plan done. And one of the problems that happens when you hear about negative stories about the reverse mortgage, it's primarily because those borrowers did not have a will or trust. They just didn't get their their estate plan done. And then I once had a case where 32 heirs, 32. And so 31 of them wanted to sell. If one of them doesn't, guess what? Can't do anything. So I would encourage everybody on here to get your estate plan done, which is not just for when you die. It's also, powers of attorney, medical power of attorney, durable power of attorney, advanced directives, all the things. Planning helps you to have a better retirement.
Absolutely. Absolutely. Well, if there's no more questions, we absolutely enjoyed learning this new tool tonight in the toolbox. Thank you again for your education and planning and knowing what options we have to exist between and the difference between fear and freedom. One of the other questions that did pop up was with regards to um, just overcoming, reverse mortgages got a really bad rap, years ago. And can you just kind of dispel some of those, why that happened? Why the negative, what it was, it still is, they still have a bad mark on it, on reverse mortgages. So can you dispel these myths and how you have overcome that? You said a lot of things in the presentation on how you have overcome, but can you just wrap that up for us?
Yes, just real quick. Yeah, you're right. It's gotten a bad rap. And the biggest thing is this lack of education. Like when people say, "Oh, I hate reverse mortgages," I always ask why, and then they start spouting stuff that's not true. And I like that. Well, that's not true. Well, that's never been true. So they don't know. And the objections usually come in the form of they think you lose your house, right? They think that you can't inherit the house, like you can't pass it on to your heirs. There's fear. Where does fear come from? Lack of information, right? And people think that either you have to have your house paid in full to do a reverse, or you can't buy, you have to have a mortgage on it, right? I mean, there's all kinds of things. And what I say, it's the street committee. Like we spend more time planning a vacation than we do getting good information. And by the way, you can go to HUD.gov and get the information. Like the information's there, but people listen to the street committee when people say, "Oh, you're going to lose your house. Oh, girl, I wouldn't do that." That's, all the things. And none of it's true unless those people have a mortgage license and they know what they're talking about. Don't listen to them. Do your own research. There's this funny thing now that you can get on Google. You can do Chat GPT. Like there's all kinds of things that you can do to get really good information. Don't listen to people. Do your own information. It's an FHA product. It's been around for 37 years, and people are using it to build their wealth and have better retirements. So I just educate. That's the biggest thing. I just educate people so that they can have good information.
All right. Well, thank you so much. I think let's see. Okay. All right. Well, that is wonderful. That's wonderful. Yes, education is key. So let's, we talked about, we heard a lot of great information tonight, and the next step is to see how this fits in your unique situation, because everyone's goals are a little bit different. And so some of you may be thinking about downsizing, right sizing, or even purchasing your first home. Some may want to free up cash flow, and others may be exploring this program to fit your tax and estate planning. So I love to invite you to schedule a free 15-minute strategy call with me. During this time, we'll walk through your goals, understand your options, your strategy, and if this program is for you, we will get Genie on the phone with us to go through the next steps to see if this is a great fit for you. And remember, planning ahead isn't just about finances, it's about stewardship. stewardship. So we've been entrusted with so many resources, and our job is to maintain them wisely so we can live with peace, bless our families, and more importantly, leave a legacy. So that is my information to, you can scan, you can go to this bit.ly/chat with Myra. All right, so our next one, we have already done the encore. This we did one this morning. This is our encore session, and we will be doing more in the future. And one extra bonus is today is the last day to enter into my Fall into Fortune giveaway. If you have not entered, we are giving $1,000 away, so that can go towards building your legacy. So if you can scan that QR code or just go to that bit.ly/Myra Fall Fortune. Tonight is your last time to enter. So, so please do that. And then this will also allow you to get on our VIP mailing list. All right, so stay connected with me. We look forward to more eye-opening workshops like this. We will present more workshops on. I will have a tax strategy, how to pay less taxes seminar very soon before year end, and also how to use real estate to reduce tax liabilities and lower your tax bill, and so many other workshops. So please make sure you connect with me so you can stay ahead. All right. Well, everyone, thank you so much for attending tonight. This is the end of Retire Smarter. We hope and trust that you enjoyed tonight. And remember, my mission is simple: to help you walk in wisdom, live in peace, and leave a legacy for the future generation. Thank you so much for joining our Retire Smarter workshop. We will see you on the next class or workshop. And God bless. And remember, your best financial chapter is still ahead. You all have a blessed night and have a better than great day or evening. Bye-bye.
Bye.